Welcome to another episode of Pip Talk Podcast. Accompanied with me today, we do have the man from Crenshaw, Mr. Jacob. He's pulled out his brace today, so actually, I don't think I can call him the man from Crenshaw. But Jacob, how you doing, bro?
I'm doing great, bro. How are you?
I'm very good. And big shouts to some of the people on our live stream as well. I know Mr. Burry's in there, Michael Burry. So I know he could hear us. But one thing that we wanted to discuss today and really moving forward is provide you guys with these episodes, a bit like what we used to do before on our podcast channel with the Spotify and Apple, which was just providing you guys with some more information regularly, to actually allow you guys to have a further insight into the financial markets and what's actually happening. So one of the newsletters that we just recently sent out was based on Japan. Japan has dumped a record-breaking number of US Treasuries. Now, usually what we tend to see happening is when the rates go up, mortgages are more than likely most probable to default. And right now we're seeing some of the most long-standing bond purchasing countries selling off these Treasury bonds. So I think we wanted to go a bit back and forth because I know Jacob's got a different opinion to mine. I think sometimes I might think a bit more short term. He might think a bit more long term, vice versa. But Jacob, tell me, is this the end of the dollar or what?
I think there's a very big potential for it. Just basically understanding the macroeconomics of things and what Chairman Powell has kind of been spewing as of late in what he's been saying with the meetings regarding interest rates and inflation, and kind of understanding the central bank stance as well. I think it's very important to kind of know where the central banks and what their kind of focus is on. And going off of what Chairman Powell last said, it did sound a bit hopeless. It did sound a bit like they're a bit unsure of where they're really willing to go in terms of rising interest rates and stuff like that, in terms of how big the interest rates are going to be from the next, the months coming and things like that. So I think where there was a bit of confusion created, maybe it's actually on purpose though. That's one thing that we can't rule out as well. I do feel like the central banks could be giving us smoke and mirror tactics, whether or not that's the way that they're actually implying in terms of communicating with people. But some of the questions I felt like they weren't answered straightforward. And that's due to the fact that I don't think they're really under control of the actual situation regarding inflation. So they keep saying there's a target of 2%. And, with rising interest rates within a couple of years, we are due to curb that. But what they're not understanding is that with the balance sheet outstanding and things that they've leveraged against in terms of the housing market, is that most of those things were leveraged under smaller interest rates. So with the interest rates continuing to rise, it doesn't really add up in that sector specifically. So I do think that we could see, with inflation not being curbed, problem.
Yeah. And that kind of brings me on to what I just said prior to you mentioning that, is the fact that if inflation isn't going to be curbed, rates will continue to rise. Just today, we had the Royal Bank of Australia raise their interest rate from 2.85 to 3.10%. So that is also another indication that no matter how far you are in the world, whether you're next door in Europe, whether you're in Europe or you're in Australia, why are you laughing?
Who, me?
Yeah, you.
I laugh. I'm just smiling, bro.
Okay. Yes, whether you are in Europe or you're in Australia, we can see that globally, these central banks, they all know what they're doing. They've had their meetings, whether it's the G7 summit or whether it's private meetings on WhatsApp, who knows? They've had their meetings in this and their discussions. And we know very clearly that the rate is going to be continuously hiking. And it's a well-known fact, historically proven, that when the rate hikes, this provides more of a chance of a default on mortgages. So what that means is that this is a ticking time bomb, which most people may or may not be aware of. And that's understandable, because if you think about information such as what we're providing right now, to an average investor or to an average Joe who's working a 9-to-5 job, who has a savings account and the stocks and shares ISA from the bank, they're pretty much none the wiser to what's actually happening behind closed doors. It's a bit like when you look at, when they say there's more to what meets the surface. This is a prime example of there being more to what meets the surface. And I think the next crisis will be the dollar crisis. And of course, it's only a matter of time. This has happened to other nations in the past, like, for example, Great Britain. The debt, their debt to GDP was all out of whack and it took over 30 years to realign. Now, the UK lost its status on the world stage, and America, they'll most likely still be okay. I was actually having this conversation with someone a couple of days ago, and I was saying, from an international corporation or from an international business revenue perspective, America is one of the only countries that has outstanding business coming back into the country, international business. And we can look at the companies like Amazon, Netflix, Apple, Adidas, McDonald's, KFC, Microsoft, Coca-Cola.
Yeah.
And that's 8 companies, And now
let's Tesla. You say Tesla?
No, I didn't say Tesla. Tesla again. That's 9. And those are some real big hard hitting companies, and we need to, Starbucks would make 10, right?
Yeah.
So we got to think in times of an economic downturn, or in times when we was in lockdown, when, globally we was in lockdown, those 10 businesses were most likely still making money. McDonald's, KFC, I forgot Burger King, Starbucks, Netflix, Amazon, they was all still making money. So the dollar has had a lot of strength behind it for quite some time, but the way the way the markets are moving at the moment does put me into a different position to believe that this truly is a ticking time bomb. And the question is going to be now, who is going to buy the US debt? Time and time again, China and Japan have bailed out the US. But if we look at the charts and we actually check the Treasury holdings for China, or the Treasury holdings for the US, we can see that Japan and China, have been offloading a world record breaking amount of bonds that they've been offloading. So this definitely does seem to be like the telltale signs before we start to see something happening. And it's not inconceivable to think that the Fed can actually step back in and print some more money, because another interesting fact is the Fed don't get audited. The Federal Reserve do not get audited, which means that they can pretty much do what they want when they want. And the last time there was a recession, the Fed bought back $4 trillion worth of bonds. Okay, this time around, it's very clear. And I was watching an interview earlier on today from a wealth manager, and he mentioned that in 1950, America actually bought all of the debt globally. No, they pumped money into the world, not just into America. They pumped money back into the world to get things pumping. Mm-hmm. So you have to understand, that's really scary from a country that has no real assets. All of their assets are taken from overseas, and they continuously print money, which means that they weaken their currency. And it's got to come to a point where surely we've got to look at silver and gold and other commodities, right?
100%. So when you actually look at the amount of money that we printed past COVID, in terms of how many business needed helping out and things like that, it's very hard to believe that they didn't realize we would end up in this position. So again, that's why when we hear these comments from the chairman or the president of the central banks and stuff, they kind of play the game where it's like they weren't to know. And that is where it's kind of dangerous for your normal average citizen to believe that, because I feel like the effects should have been judged before they were actually used. In terms of the amount of money that was being printed, it was definitely within their best interest and the country's interest to actually understand, okay, how much money can we print before this becomes a problem? There was none of that. Okay, so whether or not this is the outcome that they actually wanted to destabilize the currencies as we know it, we could be seeing that deployed as a tactic. So where there's been talks of a recession, talks of them regulating crypto spaces, talks of them bringing in central bank digital currencies, we kind of have to understand that the comments being made could be part of the actual bigger picture in terms of the macro plan. So stuff like gold, silver, commodities, and things like that, they're due to be boosted in value in the coming years, we believe. So whether or not now's the time to be buying some of these assets, I do believe we kind of need to step away from thinking that currencies as we know it are just going to continue to kind of be world reserve currency, and especially the dollar. Like, we have to kind of consider, is this going to be the world reserve currency moving forward? Based off of comments that are being said, it's kind of pointing to something different. Whether we can kind of pick a winner is yet to be decided, but I do think we need to think about other entities kind of taking over gold. Maybe we get a currency that's actually backed by gold. Who knows?
Yeah. Well, it's interesting that you mentioned that, because a couple of things I wanted to say was the risk appetite or the risk exposure, the exposure to commodities from average investors statistically is actually less than 3%. So less than 3%. People have, no more than 3% of risk in their portfolios of commodities. And
Right.
if we look at how the commodity markets work and how they have worked, it's the only market that can actually be correlated to actual physical, tangible money, meaning gold and silver has always been worth something. They've never not been worth anything, right? And between 3 to 5% is usually the risk. That's the statistics for risk that aggressive investors have within their portfolio of commodities, more specifically silver that I'm talking about here. But historically, we can see how well silver and gold have done over the years. And, we can't ignore the fact that oil's also had, oil's the only commodity that we've seen in our lifetimes go to zero and bounce right back up like it was never down there in the first place. So it's not necessarily like we are not actually being able to see the value in these commodities, because whether the price, or no matter how high or low the price does fluctuate, we always see the end result, which is value. Now, Japan and China pared back holdings of US Treasuries in May to multi-year lows. And the data from the US Treasury Department showed this on Monday, which actually was quite interesting, because what it showed you was that Japan's holdings fell to 1.2 trillion, the lowest since 2020 in January. Now, usually the holdings was at 1.8. So you can see from 1.8 to 1.2, it does look like there is a specific reason as to why they're doing this. And even China's hoard of US government debt dropped as well to 980 billion in May, still the lowest since May 2010, when its holdings were at 847 billion. But nonetheless, we can see that China did have over 1 trillion in treasuries. So, for Japan and China to be working next to each other alongside, almost as if brothers, one country informing the other and then both selling around the same time, definitely does look suspicious. Michael Burry, if we remember, last year, was it? And he started to sell off all of the big stocks right before COVID. If you remember, Michael Burry started to sell Microsoft stocks, and I don't want to name which stocks. I don't want you guys to hold me accountable, but I remember a specific post, and it did say Michael Burry was selling a load of these blue chip stocks, and sooner rather than later, we went into a recession. So it's quite interesting to see now that the world's second largest economy has reduced holding treasuries for 6 straight months. For 6 straight months, the world's second largest economy has reduced their holdings in US treasuries. So although China and Japan sold treasuries in May, the US treasury yields, they've still gone down. And the benchmark on the 10-year treasury yield started the month of May around 3%, down about 15 basis points by the end of the month. But most importantly here, we can't ignore the fact that for 3 consecutive months, we've had negative GDP results, across the UK as well as in the US. And for 6 consecutive months, we've had the world's second largest economy reducing their holdings in US treasuries. So if we can take pieces from each puzzle, or pieces of different factors from each areas and put them together, we can actually make up our own picture here and understand that actually there's a story to be told, and that story is most likely that there is going to be a great reset, and that reset to me is probably just another. Well, that reset to me is the biggest we've ever seen. It's a currency reset combined with a solution. I don't believe any after all of the recessions we've had in the past, I don't think no government would want us to fall into a recession without them having a solution. So in order for them to give us the solution, they first need to create the problem. And I believe this problem, well, we're on the verge of the biggest problem being created, which could allow people like yourself and I to fall into line and actually go with the solution that they choose. Because there's nothing really to say that if they turn around tomorrow and said, okay, each pound is now going to be worth one digital pound, or each pound is going to be worth 50p or half of a digital coin.
Right.
If we was to lose the value on the exchange, we wouldn't be able to do anything about it. So because we wouldn't be able to do anything about losing the value on the exchange, it does mean that they need to make sure they've got their ducks in order. As long as their ducks are in order and they can push us into a corner, we'll have no choice but to abide by it. And I believe that is coming. I believe we will. I don't believe they'll turn around and I mean, look, you know, when Bitcoin first came around and all these cryptocurrencies that started making money, we saw what happened. The mass regulation came in, and they pretty much wanted to stop people from being able to purchase Bitcoin. You had owners like JP Morgan, Jamie Dimon, the CEOs of companies saying that crypto was a scam, but really they was investing into it themselves. So what I'm really saying to you here is, I believe that they're going to push us into a corner where the mass adoption will take place only when they want it to take place, which means the message I'm saying to you here, guys, is don't wait to be pushed into a corner. Try to make that adoption yourself, because there's enough information around us. Clearly, we're taking articles from this one, from that one, and seminars from here and from there, and we're putting all of these pieces of information together and realizing that actually we're probably seeing the Great Reset happening right now. They are planning it. And the question you might ask yourself is, you know, will the Fed raise and hold rates? Now, most likely they won't. Okay, most likely they won't raise the rates and hold them. But at the same time, the inflation is a forever growing concern. And if any of you have tuned into the Fed before and seen Jerome Powell interrogated by the members of Congress, you would see that he's a tactician. You know, he never answers the question, but the questions they ask are really important. You know, 2 years ago, before he started printing out all of this money, they asked him, do you need to print out this amount of money? And he answered, yes, this is necessary for our economy to recover. And, you know, skip 18 months, 24 months down the line, when they're saying to him, well, back during COVID, you told us that we needed to do this and that it wouldn't affect the inflation. Actually, what we're seeing now is inflation is actually causing people to not be able to eat at night, not be able to sleep with a roof over their head. So the rate hikes are not necessary. The rate hikes are necessary to combat inflation, but as we've, you know, spoken so many times before, Jacob, it's always a double-edged sword with the rate, with interest. You know, good for buyers, or on one side you've got the buyers benefit, on the other side you've got the sellers. You know.
Yep. No, so that's why as well. Just to add to that point, it's very because we was actually in tune with some of those meetings 2 years ago, a year ago, when we was actually tuning in, seeing what the Fed or just the presidents of these central banks had to say. And there was a meeting with Central President Lagarde, and I remember she was saying something like inflation has risen to where it's risen because of what's going on in Ukraine and what Vladimir Putin's doing. So
Nonsense.
That's why I'm trying to say you got to really be careful with what you're being fed, because realistically, they're not really showing you the whole picture. There's no way, you know, a war is going to rise inflation. That doesn't make sense, right? Because we understand the amount of money that was printed. So you can take pictures, you know, pieces of what these people in power are telling you, but whether or not it's really the fact or really the truth of the matter, because, you know, you can kind of look back from 2 years ago, and raise the topic of, you know, saying, were these guys playing dumb, or were they being honest, or were they actually telling us the truth? So then going into when we understand, we was watching that wealth manager, that the retired wealth manager speak, and he was saying, you know, if you look at the assets that are in holdings, it's over 8 trillion now, right? And the actual money that they have in reserve is still about 35 to 40 billion, right? So with that being in reserve, if you understand how much that they would have leveraged, it's over 200 times leverage. So when it comes into people reducing their holdings, they're reducing their holdings because the risk and the open risk is too much. That is why these leaders are looking at it like we actually need to get some of these off. And realistically, when you piece together that information, they're looking at the GDP, they're looking at the inflation, they're showing signs of a recession, if like being underway at this moment. So when you piece together these things, it kind of lets you understand that, okay, you might need to maneuver in a way which is best for you. Okay, what assets do you have? What assets are you engaged in? And what do you own in your holdings? And you have to understand that if some of them are open to too much risk, you might want to actually start doing what some of these world leaders are telling us to do, which is basically reduce the risk as much as possible. Jeff Bezos made a top. He was asked about Christmas times not too long ago, and he said, "What should people be doing for this Christmas?" And he said, "Hold your money." He was saying, "Don't buy nothing." He was saying, "Hold off from buying the big TV, hold off from buying the electronicals." So if a guy like Jeff Bezos is saying these things, who makes his money from providing a service for you to actually buy these things, and he's telling you not to buy them, that's a red flag. You need to understand why he's doing that.
Yeah.
So as much as he doesn't need the money, you're probably thinking he doesn't need the money. Everyone in terms of that is a big tech company or big company, they're all capitalists. They're all here to actually grow their business tenfold, right? So if he's willing to give you advice, whether it's friendly, whether you want to take the advice or not, he's doing it because he's looking at the picture and he's being shown. There's no way Jeff Bezos isn't going into meetings and his team isn't showing him a graph of this, graph of the GDP, all of these X, Y, and Z, right? So we have to understand that picture and take it accordingly and react accordingly as well. Because I'm telling you, Jeff Bezos, he was selling some of his shares. Elon Musk sold Tesla shares. They're all cashing out to an extent. Why are they cashing out if the economy is what we think it is or what we're being told to believe it is? The economy is not as good as what we're being led to believe, right? And there is a big picture coming in terms of whether it's going to be the Black Swan event or whatever people want to call it, something that basically tanks some of these assets as we know it. We have to assume that that is on the way. And even from a technical analysis perspective, we can show you a chart and tell you that, yeah, there's something brewing here.
That's right. And what's quite interesting as well is since we've been speaking, I've actually seen that, excuse me, I've actually seen the stock market has decided to take a small tumble. Not a lot, but enough for us to at least have a look at it. It has dropped due to some news that we've just seen coming out. I'm just trying to look into it, but I can see here the Dow sinks over 500 points as the US stocks extend losses amid Fed uncertainty. So there's been more losses. There's been more earning reports, released, and those reports have led into losses. But of course, the reason why is because people are not sure about what the Fed's going to do right now. They're not sure if the Fed is going to raise the rates, if Feds are going to print more money. They're not sure what's going to happen. But nonetheless, if we actually do the maths here, if I can I've just got the S&P up on my chart here. Just want to show you guys something just so we're fully aware of where we was and where we are. Since the start of the year, the stock market is actually down. So here's January the 3rd. Yep. Since the start of the year, we've actually come down 27%. That's almost a third of the market that we've come down, right? 27%. Currently at the moment, we're down 15%. Okay. Just over 16%, excuse me. So we've recouped 10%. But why I'm saying this to you is for you to actually understand that as much as we may be looking at the market, so we might be looking at life from a optimistic point of view, we also have to face reality. And the reality is that behind closed doors, the global infrastructure has been changing and is changing. So if we can't look at the telltale signs that can enable us to actually foresee these things happening, then we should pretty much stay away from anything revolving money. Because if the owner of Amazon is going to say that he doesn't want you to spend money, it's because he's being able to understand the graphs which we're trying to teach, which is that if they can see the bigger picture, they understand that actually, I mean, look, a company like Amazon, you got to think, as much as money as they've made, they've also got a lot of outgoings. They've got a lot of staff, they've got a lot of warehouses, they've got a lot of transportation costs, etc. Right? They obviously know that in order for them to come back and to decrease their exposure to too much risk in revenue outgoings, that they're obviously trying to decrease what they're doing, their production, and probably even their staff. Okay, but it's very important that we understand as normal citizens or normal working class citizens that the bigger picture is usually told in evidence that's right in front of us. And that evidence is the bond market. We've seen for probably half a year now, we've seen the bond market dive and dive and dive to the point of now the bond market actually resurfacing back up and pulling back, as we would call it. But since the start of the year, the bond market had been pushing down, and we've now seen the bond market recover. So we have to think that if the bond market is recovering, okay, are we just now seeing more continued manipulation from the Fed? And seeing, as I touched upon it earlier on, the Fed does not and doesn't and will never be audited. We have to understand that we're trying to understand a game that has no rules.
Yeah. Also, Val, talk about Elon Musk laying off 11,000 Twitter work work employees.
Yeah. So
go on. Yeah, we had Elon Musk, he laid off 11,000. Mark Zuckerberg then followed suit. So we got to understand, these head figures, they're not just, saying, oh, I wonder why he done that. They're obviously being shown a picture to suggest something is coming.
Yeah, it's very true. It's very true. And one of the main important things that I think is always important to an investor or just to a person of knowledge is where you get your source of knowledge from. And your source of knowledge can come from, friends, it can come from news stations, it can come from social media. But it's very important when you use credible news stations like Bloomberg, and I'm going to say credible in inverted commas, because we understand that at the end of the day, you've got the Western media and you've got the external media outside of it. Now, I'm located in Dubai, so I'm quite fortunate enough to not see the Western media the Western media adverts pop up. I don't get those they're not in my cookies, right? I get the raw truth and unfiltered news, which is pretty much like the show we're giving you guys today. But it's very important to look at the earning reports. As I was saying to you a second ago, earning reports is important. The picture is right, the evidence is right in front of us. They say the easiest way to hide the proof is to put it in plain sight. And it's the evidence that we need to be looking at: the GDP, the earning reports, the CPI. We already know what inflation is doing. We already know that. But nonetheless, when we look at the CPI results, we can have a deeper understanding of where we were to where we are. Right now, I've got Bloomberg on in the background. They said the stock market's up 2%, but really we're down 16% over the year. So where we were to where we actually are is two different things. Mm-hmm. They're making it seem like where we are is great, but where we were was even greater. So the earning reports, looking at things from a fundamental perspective, they're very, very important. And also making sure you're informing yourselves or understanding the technical side of things. Because look, man, let's be honest, how these markets change and how these markets tend to adapt is by things that happen over a period of time. When we see the ECB making their changes, they don't wake up one morning and say, we're going to change something. When we see Jerome Powell coming around and saying he's going to increase the rates, there isn't something that just happens overnight. There's usually a big inclination of us knowing that these things are going to happen before they happen. So if I could just summarize on the Chinese Japan and China dumping the US Treasuries, let's look at it like this, okay? If there was some type of crisis, like a severe recession or risk of default, and there were not enough buyers in the open market, the Fed would probably step in, as it has done in the past, in the 2009 recession, and they've bought the bonds. They've purchased the bonds, and its aim in the recession was to push long-term rates down to stimulate the economy, and they bought $4 trillion worth of bonds to do this. So although they might have been trying to think of the long-term picture, they still created a bomb. The bomb is always created. Anytime you naturally try to inject something into something that you shouldn't be injecting, you're going to have a ripple effect of a reaction. And it is not inconceivable that they would do this as the buyout of a last resort. But Japan's national bank has been buying bonds to cover the Japanese deficits, monetizing the debt for years now, and nobody's even blinked. So we are heading down the same dangerous road if we don't return to fiscal responsibility and rein in spending and increase taxes like Europe. Look, for those of you watching this right now on YouTube, you might be in Europe. Some of you might be outside of Europe. But if you are inside of Europe, you'll know that things are really expensive right now, especially if you're in London. So those who are on our live stream, I know you guys are feeling the pinch back home, just in terms of the taxes, pretty much coming from everywhere.
Yeah.
And households have to balance their budgets or they will go bankrupt. It's really as simple as that. And if governments don't balance their budgets, then they'll go bankrupt too. So it's a sink or swim environment right now, in my personal opinion. And I asked the question that, if it's time to see mass adoption, okay, for the new powerhouse, is it time to start learning some Mandarin? It might just be, it might just be. So we're going to end it there for today's Pip Talk podcast. Thank you guys for tuning in. We will be back with another episode very shortly. And I'm going to end it with some Mandarin, and I'm going to say sheshe or sheshene. Sheshe, I think is appropriate. And we look forward. We thank you guys for tuning in. If you're watching this on YouTube, be sure to like and subscribe. If you're listening to this on our digital platforms, on Apple Podcasts or on Spotify, be sure to smash the like button if there is one, and let us know what you thought about this episode. And
also, guys, make sure as well that you subscribe to our newsletters. Okay, it's going to be really important. There's going to be a lot of information there that you need to be in the know about, whether or not you're able to actually decode it, or you need a bit more answers than that. Definitely tune in, because what we're providing with these podcasts is that you can understand how the economy is, and not only the economy, how you can actually react and benefit and put yourself in a way better position. Okay, information is key so that you can actually set yourself up. But there's no point in a recession coming and we're really in it, and then you start doing the work to actually understand how you can benefit. Okay, you need to be prepared. That way, when it comes as the opportunities come, you're not in the know too late, and you're ready to actually fire away.
Yes, perfectly said. So yeah, guys, that's us for today. We're going to head over to our live stream now. So of course, thank you guys for tuning in, and always remember, every day
is money day.
Peace.
Peace, guys.